Welcome back, welcome home. It's Justin, your local real estate agent. This is your weekly market update, and this is video number 2 in our series on how to deal with these rising interest rates. Got a program that I think you'll be very excited about, so stay tuned. And if you missed last week talking about the seller subsidy, go check out that video from last week. We'll drop a link to that one down below. All right, let's get started. All right, look at this, look at this, look at this, look at this. Look at our market update. This is just single families in the Bronx for the last week. And I would go into more detail on this, except it's pretty much the same as it was last week. So go check out last week's video if you haven't. You're sellers, you're looking at a lot of price decreases, right? We're getting a lot of expires coming on the market. Buyers, demand has dropped, which is good for us. Supply is not really where we need it to be yet. And as you know, interest rates. All right, boom, look, hold on, let me put these tabs in order. U.S. mortgage interest rates rise to highest level since 2006. Thank you very much. You'll see people with a lot of 7% being floated out there, 6 3/4. It's tough times. So this series is really focused on how we're going to deal with these interest rates. So of course you have the common 7 ways right here: shop around, improve your credit score, make a large down payment, choose your loan terms, buy mortgage points. We'll actually do a quick video on buying down your rate locks, refinancing your mortgage. But let's get creative. So let's talk about SmartMove New York. Now, there's also SmartMove Connecticut for my Connecticut folks looking to purchase out there. This is a program for first-time home buyers only, okay? So if you just sold your home and you're looking to buy another one, you know, if you just sold your home like last week and you're looking to buy another one, no, unfortunately not. We can't use this one, all right? So first-time home buyers. This can provide us, let's get to the actual details, the down payment of up to 25% of the sales price or appraised value of the property we're buying. Up to 25%. Did I pause long enough for that to sink in? That's huge. Now, this is not a grant, right? This has to be paid back. This is a loan, right? They have a nominal interest rate here of 3%. APR is actually fluctuating between 3.42 to 4.74%. It's a 20-year term fixed rate mortgage. You'll make principal and interest payments on it. It's a second mortgage that you're borrowing, right? So if you do not have a lot of capital, or you don't want to use the capital you have, and you qualify for this program, you might be able to use up to 25% towards your down payment. We actually got a little math coming up, so stay tuned. But a couple things you need to know. First-time home buyers are people who have not owned a home in the last 3 years. This is for single families, 2 to 4 families, condos, right? Co-ops, not allowed. No co-ops, okay? You have to live in it. This is only if you're purchasing. We got credit score requirements. We got income caps. And you have to come with at least 1% of your own funds towards the purchase. So if we're buying, let's say, $800,000 property, you got to come with at least $8,000, okay, of your own. And then this program can kick in. Now, why is this such a big deal when we're talking about interest rates? You're asking the right question. Great question. I love the energy. Well, because with the rates being what they are, we're seeing payments going up, right? We still don't have enough inventory. You know the whole story. This is a way that we can shave off potentially a few $1,000s a year. And then depending on how long we actually have these loans, you know, it could be big savings over the course of 30 years. Okay, so let's break into our first example. Here we got a little mortgage calculator. We're going to assume we're buying a home for $800,000, putting down 3.5%, you know, FHA standard. All right, loan amount 772, interest rate 7%. I know. I know. All right, loan term 30 years. Boom, property tax is $6,000. We have a mortgage insurance. I'm gonna say 0.5%. Don't know. Check with your lender about the mortgage insurance. Check with your lender about all the numbers. Honestly, you gotta check with your lender. But this is just for illustrative purposes. All right. Home insurance $1,800 a year. Boom. So we're looking at a monthly payment $6,107.80. All right. Now let's get into our example. We're using the SmartMove, where we get that 25% down payment assistance, right? And this is assuming we paid our closing costs in full. So now we got same home value, 800,000. We're putting 25% down. This is the second mortgage. We're going to cover that. Look at those numbers in just a minute. Now our base loan amount's only 600,000. So now that interest is 7% is only on that 600,000. And our first example was on 772,000. So we shaved off a ton of that. Same 30 years, property tax is the same, homeowner insurance. Now look, we put 25% down. There's no PMI. There's no mortgage insurance. Right? So now our monthly payment, just based off the 600,000 we're borrowing, is $4,641.81. But that's not it, because we have a second mortgage. So let's go look at the down payment assistance, assuming we got that full 25%. That's going to be $200,000 that we got in assistance, right? We're not going to put any down payment. This is the down payment, so this stays at 0. But the interest rate on this is, let's say, 4%. Could be lower. We saw it could be 3.5%, right? Could be higher. But let's just say it's 4%. It's 4%. The loan term is 20 years, so we're paying this back over 20 years. There's no mortgage insurance on it. Your monthly payment, $1,211.96 for the second mortgage. I did some math ahead of time because, I like to come prepared. Hold up, wait a minute. So now we're going to take that $1,211.96. $1,211, yeah, that's right. I said it right. You always got to check in your mind. Plus that $4,441.81. Boom, we're at $5,853.77. Okay, off the bat. That's still lower than the $6,107.80 if we just did the standard 3.5% down with our FHA. Okay, so now let's do some more math. I done lost my example. Let me add this up again. This will be removed in the editing. You won't even see this part. 4641.81. So 583. So we're at $5,853.77 minus 6,107.80 cents. That's a difference of $254.03 a month. Now we multiply that by 12. That's an annual savings of $3,048.36, assuming we got 30-year fixed rate mortgages for the first 20 years, right? So you're saving that. So we're going to do 3,000 times 20. So over the first 20 years, you're saving $60,967.20, assuming you got both those loans for the full 20 years. Then after that, you drop off this $1,211.96 because this has been paid in full. Your down payment assistance is done. Now you're just looking at this $4,641.81 for the remainder of the life of your loan. Now, of course, you might not hold on to a loan for a full 30 years. A ton of people refinance after a certain amount of time. But even if it's just 5 years, $3,000 a month, $3,000 a year, times 5 years is still $15,000 in savings on interest, right? So that's something that can benefit you in the short term and definitely in the long term. Now, this program you can only use this program with a few lenders. Feel free to reach out to me. I have a referral if need be for New York and for Connecticut. And follow, like more. We'll be back next week with another idea on how to deal with these interest rates. But let me know what you think about this one in the comments, and I'll talk to you soon. Bye.